Connor, you're ready to go?
I am ready. Thank you.
Excellent. Great. Well, on behalf of myself, Jerome, Mike, and Richard, we'd like to thank everyone for attending our webinar today. Today is going to be centered around behavioral finance. And the reason why we're going to be doing it at this time, which is the same time every year we do it, is to remind everyone that historically in the fall, markets can become volatile. We feel like this is a timely area in the calendar year to start reminding everyone about investment policy statements, rebalancing, and staying balanced and level-headed. As we enter this period, it won't be new, it won't be old, but we want to remind everyone that tried and true theories, practices, and ultimately asset allocations are what always work through this. In saying that, we've invited our friends from BlackRock back, as the last one they did last time had a lot of high regard and marks. Connor, I'd like to have you take it away and start the presentation today and talk about behavioral finance.
Awesome. Well, thank you so much, Chris, and the rest of the team over there at Signet. Hopefully you can see the screen okay.
Yeah.
And also thanks for all the attendees out there joining us. I hope everyone's staying safe and healthy and, importantly, making the best of the summer thus far. As Chris mentioned,
Connor, real quick, you might want to get full screen mode because I can kind of see some other stuff on there.
Okay. Let me get the full screen mode up. Is this better here? Just make sure it's okay.
Yeah, I just can see some of the stuff on the right, like the literature and some of your notes.
Okay. Let me try this then. Hold on for me 1 second.
Yeah, you got it.
Still doing that?
Yeah, I still see it on the right.
Huh.
If you want, I can give mine a shot.
Yeah, if you don't, maybe just give me 1 second. I'm going to try to get this up properly.
Sure. Sorry for the technical difficulties, everyone.
Oh, no problem. Let's try this here.
That can work too, Connor. I mean, if you got to.
Okay. Maybe we'll just start here, if that's okay.
Sure.
I'm sorry about that.
That's fine.
And we'll just jump right into it. So, you know, as Chris and I were talking about what we can certainly offer from an educational standpoint, I think BlackRock's certainly a large firm with tons of insight, but hopefully we can share and shed some light on something a little bit different today that we find is a bit more relevant, especially in times like this. And oftentimes it's the most important thing when you're kind of developing an investment plan, which is the idea that markets go through swings, ups, downs, and sideways. And the most important topic to us is how do we stay disciplined and allow ourselves and allow our investment plan to work over longer periods of time, but also try to think about avoiding some of the common pitfalls that investors make when times are very volatile, like March and April of last year, or when everything seems to be great, like, 10 years into a bull market between 2009 and 2020. So what we would like to start to try to think through is how do we ultimately control those emotions and navigate through difficult times and good times, which leads to, in our opinion, long-term financial success as well too. And I don't think it's any real secret, but the world is certainly a much different place than it was this time last year and even definitely 2 years ago. I would say the big things that we have been hearing from investors over the last 12 months are feelings of course, worry and fear. But I think the big thing that comes oftentimes up in conversation is just uncertainty. Certainly uncertain about the economy and the amount of spending the government's doing, uncertainty around jobs and things like inflation. There's a ton of questions out there. And what that can oftentimes lead to, as what we've seen, is this feeling of what we call paralysis by analysis. And when it comes to investing, in our opinion, what we need to try to do as best as we can is start to separate things that are emotionally driven through things that can be much more impactful to us over longer periods of time that can impact our decision making. And when external factors are rough, like we all experienced in March and April of last year, that can really enhance what we call the fear of loss. And unfortunately, media sources don't help. But the questions we often get asked over and over again when it comes to investment success is, how do I make more money? How do I reduce taxes or properly prepare my estate? Do I own the right things from an asset allocation and security selection standpoint? And all those things are really important. And I'm sure Chris and the group over at Signet Wealth are talking to you about that on an ongoing basis. What we really want to focus on today is just those foundational fundamentals and the idea that you can have the greatest financial plan and the greatest investment plan put in place for you, but the foundational piece of that plan is our own investor behavior and the idea that a perfect plan will fail itself every single time if the investor or the plan holder is not disciplined enough to follow it. So that's really the nature of what we're trying to talk about. And go ahead, Chris, feel free to chime in.
I have a quick question for you. Do you find that people feel more uncertainty now or last year in March and April? Although I have no empirical data on it, I find a lot of uncertainty is actually coming up now because there's so many different things to worry about. As to your point, inflation, taxes, blah, you know what I mean? Whereas before, I found most clients were worried about their health, obviously their financial security, and their family. It was those three things that were very consistent themes that we needed to watch out for and discuss heavily last year. This year, there are several concerns I hear people discussing. So I'm curious to find out if this is something that BlackRock has seen or measured as well, or if it's just where we are in this point right now.
That's a great question. So I think the level of uncertainty that we see through investor surveys and all sorts of things that BlackRock does is very the same from a level standpoint, but the underlying things that people are concerned with are totally different. So to your point, Chris, last year it was much more personal oriented, health, financial security or employment, as well as, what the deal is with COVID. Now it's a little bit different when it comes to, there's a lot more questions and concerns around things like interest rates, inflation, much more investment oriented, where last year was a little bit more personally oriented. But I think it's a good call out. And it does kind of go to show that I think there are always things that people are curious and concerned with. And we have to be able to kind of demystify some of those concerns and actually break it down to what does it truly mean for you when it comes to your investment plan. But I think it's a good call out.
Thank you.
This presentation is designed to be a bit more interactive than others. And, what we like to do is just kind of start with a little bit of a thought exercise. And there's a point behind this. But if we just kind of go down this route of, if you were faced with a really extreme choice when it comes to your investment account, and all the information that you had was the stuff that you see here on the screen, which is just historical performance of 4 different investments, which one would you feel most comfortable putting really all of your net worth into? And while you're thinking through that, if I can talk through the options quickly, what you're looking at really, in my view, is this orange line, which looks to be a pretty volatile, maybe stock or some sort of fund. It's moved around a bunch and it's kind of fallen off a little bit of a cliff over the last couple of years, what it looks like to me. In the middle of the screen, you start to see this green, much more smooth mountain chart, but certainly gone through some peaks and valleys over the years. This pink one in the middle of the screen looks to be a much smoother ride, lower volatility in our language, and looks to be a pretty smooth and growing investment over longer periods of time. And then yellow at the bottom here looks to be pretty low risk and something that isn't growing much, but it's certainly not losing you money. And, when we do this in person, there seems to be kind of a couple of themes that people pick. In most audiences, there's usually 1 or 2 folks that shoot their hand up when you look at that orange line, and they're a little bit more aggressive type of investors and say, hey, maybe this thing's at a good value and I can buy it now. Most audiences that we talk with seem to pick the sure thing, and that's not a bad thing. But this pink investment here in the middle looks to be one of those Goldilocks scenarios, growing quickly, not losing money over longer periods of time. There's been really very few dips of any significance. But if we start to unveil this curtain a little bit further, now you start to see what those options actually are and how they've actually done historically. So the orange was actually the historical chart of a name that we probably all know, especially over the last year, of Pfizer. In green here, you're looking at the historical performance of the S&P 500. In yellow, it's the historical performance of treasury bills, which are just really short-term debt instruments from the US government. And then in pink, this one's a little bit less commonly known. It's called Fairfield Century. Not sure if anyone's heard that name, but it is associated very closely with a guy by the name of Bernie Madoff. So Fairfield Century was actually the feeder fund for Bernie Madoff's Ponzi scheme, so to speak. It seemed to be the perfect investment at the time based on historical data, but was later discovered to be arguably one of the biggest frauds in US history. So we say all this, and it's a little bit tongue-in-cheek, but it's just to suggest this idea that in this investment world, we would argue, even as a large investment manager, there are really no magic bullets or perfect investments that apply to everybody. Investing always involves risk, and performance oftentimes can go through some pretty large swings. And that's important to understand before you even get involved in any sort of security. And when we're thinking through some guidance from people that have done it really well historically, we have found that Warren Buffett says it really well. He says, in order to be successful when it comes to your investment portfolio, you don't have to be smarter than the entire population. What you do have to be is a little bit more disciplined than the rest and make more clear decisions when everybody else is in a bit of a frenzy. And that to us there was never a better example than March of last year, where everybody wanted their money. Everybody wanted out of the market. And then sure enough, from April until today, stock markets have been on a pretty good ride since then. So again, discipline over intelligence to us is one of the things that is really paramount when it comes to how do you build long-term investment success. And in today's presentation, there's a couple of things that we'll hit on. The first thing that we'll talk through, just to avoid some of these, call it detrimental tendencies that people have. One is, what are these feelings of envy that people typically have when markets are doing really, really well? The younger generation in the country calls it FOMO, or fear of missing out. But the idea is, how do you keep up with everybody? Number two in the middle here is loss. The idea is pretty simple, but it's true. Investment losses often feel twice as bad as the gains feel good. And those emotions can easily take hold in periods like March and April of last year. And then lastly, how do we remain disciplined through this entire roller coaster? And if we start with some of these feelings of envy, there's a couple of things that we want to hit on. One is these ideas or feelings, I should say, of regret. The second is what we call the lottery ticket effect that many of us probably have, myself included. And then the last one will be, how do people miscalculate the risks over and over again? And what we try to do in a lot of these types of situations or throughout this presentation is we want to try to give you some form of a real world experience, not investment related, and then apply that to how those same exact feelings start to apply to the way you look at your investment account as well too. And one thing that's super relevant, I'm a huge Olympics fan, so the last couple of weeks have been great for me, but the idea is pretty simple, that if we were all perfectly rational people, we would only regret when bad things happen. But so often, people of all shapes and sizes regret what could have been or what I maybe missed out on. And a great example of this is this study that's done by the Journal of Personality and Social Psychology about 10, 15 years ago. But they really just asked a very simple question and polled every medal winner at the most recent Olympics. And they asked them the simple question of, if you were to rate your happiness with the outcome of your event or race or whatever it was from 1 to 10, what would you say? And what was interesting to us is that bronze medal winners actually appeared and demonstrated that they were happier with the result than silver medalist winners, even though they came in third, not second. And we start to ask ourselves, well, why is that? And how does that apply to an investment portfolio? But the idea is that a silver medalist winner probably thinks about how hard they trained, how close they came to reaching gold and probably accomplishing a lifelong dream of theirs. While a bronze medalist winner probably thinks about, well, hey, I was just as close to silver than I was to not even being on the podium. So I'm kind of just happy to be here. And I think that difference between what we call relief and regret is very relative, and it certainly applies to the way that you interpret the performance or the success or failure of your investment portfolio as well too. And many of us have probably felt that in our portfolios over the years. And this slide here is a really perfect example, and it's all real data. And we're probably feeling some of those thoughts over the last 12 to 18 months as well too. And really what we try to demonstrate on this chart here is that so often investors of all asset allocations will compare their portfolios to the stock market. I'm not saying that's a bad thing, but it oftentimes sets you up for some really negative feelings. And what this really tries to show you is if we take a diversified portfolio of 60% stocks, 40% bonds, and compare it to the S&P 500 going back to 2000, those feelings of envy and regret start to surface themselves over and over again. But when we look at the final results, it's actually a pretty interesting picture. But not to skip ahead, what you see here is basically if you were to look at the tech bubble in 2000 or the financial crisis in 2008, a diversified portfolio certainly doesn't defy gravity, but the S&P 500 was down 40% and 37% during those two correctionary periods. And unfortunately, a 60-40 balanced allocation was down as well too. It wasn't down as much, but it was certainly down. And those feelings of, hey, I just lost 17 or 25% of my investment account, those aren't great feelings to say the least. Those same type of feelings, just the opposite, start to surface themselves in periods like 2003 to 2007, or most recently, 2009 to 2019 during our recent 10-year bull market, where the opposite was true. Stocks go on a tremendous rally. 350% over those 10 years are some really impressive numbers. And a diversified portfolio will probably never keep up in those time periods, intentionally so. But those emotions of I'm losing out compared to what everybody else is making, what the stock market is giving us, those are some really dangerous fears and feelings of envy that we want to try to help you avoid. Because when you look at the final results here, what's interesting to us is that if you take a diversified portfolio, much like what Chris and the group at Signet Wealth build for a lot of investors, even though it feels like you're losing these battles over and over again. When markets are down, I'm down too. When markets are up, I don't even keep up. It feels like you're losing every battle along the way. At the end of that rainbow, your total returns have actually outpaced the broader market if you have been patient and diligent about staying invested. And that's what we try to emphasize here, is that diversification is working, even though it feels like you're losing over and over again. That's kind of the point. If we can minimize the peaks and valleys, you will always outperform the market if your portfolio is built efficiently. And that to us is a really big deal, and probably one of the big takeaways from this entire time together. But diversification works. We just have to be disciplined enough to let it work for us over longer periods of time.
One thing I'll add in there real quick, Connor, too, and it's amazing to me that when we meet with new clients, part of our interviewing process is trying to understand what their feeling is around risk and returns, right? The first conversation we have is around diversification, making sure that we all understand that it's not just one, but a bunch of solutions that ultimately get you through good and bad markets. And it's amazing to me after we have that conversation that someone will bring up, how do you do against the S&P? And we have to reconcile that conversation right, saying like, hey, wait a minute. If we agree to the fact that we want to be diversified, then we're not comparing a diversified portfolio ultimately against just one index, but rather all of the indices your portfolio represents. We then talk about, to your point, like taking that step of diversification further, including small caps, mid cap, large cap, different durations of bonds. And we put these all together, and when you're actually able to show them that and then compare it as you're showing it against the S&P, it becomes even more of a compelling story as to why diversification is so important, and to stop measuring your overall net worth and asset allocation against one indice. You'll represent some of the S&P, but you're never going to own just that and be able to beat it or overperform when things are really rough. So I just think it's really neat.
Yeah, totally agree. Yeah. The next thing that we talk a lot about is, you mentioned it before, what we call the lottery ticket effect, but it's just this idea that in a given year, the average American spends about $223 for each person in the country on lottery tickets, which equates to about $73 billion spent on lottery tickets. It's a pretty big number. Even though we probably all know deep down in our hearts, none of us will probably ever win the lottery. I hope you do, but the chances are about 1 in 300 million that somebody actually wins the Powerball. And to us, what's abundantly clear is that a lot of people look to get rich really quickly, and oftentimes it never happens. When it comes to investment implications, a lot of folks look at individual stocks, looking for that next great investment company. Like, if only we could go back and buy Amazon when it was still an online bookstore, how great would that be? Those are really difficult things to do in real time, because there's a lot of risk in individual companies like Amazon back in 2000. But we all, I think, kind of fall victim to this idea that if I can only find that next hot investment trend, I'll make some serious money. The challenge is, when it comes to the way you actually invest, what's interesting to us is that the success or failure of picking individual stocks becomes really difficult, especially trying to find the next Tesla or the next Apple or Amazon. Very difficult to do in the early stages of those businesses. So much so, if you look here, U.S. stocks on average are up about 15% each year from an index level over the last 5 years. But when you look at the individual pieces of the U.S. stock market index, there's over 1,500 different U.S. stocks represented in what we call the total U.S. stock market. About 66% of them are positive over the last 5 years. But also there's about 35% of them that are negative still over the last 5 years, during a period where markets have gone up exponentially. Those are individual stocks. On the right-hand side of the page, when you think more about what we call diversified products like mutual funds or exchange-traded funds across all firms, in the entire U.S. mutual fund and ETF industry that are owning a bunch of securities in these packages, 99.8% of them are positive and only 0.2% of them are negative. That to us is a much better batting average than 60-40. And it just goes to show that even though a lot of us probably own, I know I do, I own some individual stocks. When you're thinking about a truly diversified portfolio, the way that you accumulate wealth over time, mutual funds, ETFs, or just a more diversified portfolio is definitely the way to go, in our opinion. What we think is, from a key investment trait standpoint, one of the biggest and most important things to always be thinking about is, do we actually understand how much risk we're taking, but also how much downside we can potentially be exposed to? And that to us is of critical importance. And when you start to think about it, if you just look at the top left of the screen, that gray box, this to us is one of the big deals that when it comes to building efficient portfolios, we have to be mindful of. And again, the other thought exercise I would just put on your plate real quick is, if you think about what losses actually mean to you, and if I were to hand you $1 or any dollar amount, doesn't really matter, today, and overnight you would have lost 50% of that, how would that first of all feel? And then the question that comes on top of that is, well, what do I have to make back just to get back to even? So if I hand you $1 and we lose 50% of that account, you would be sitting on 2 quarters or 50 cents tomorrow. But then from there, the question that I always ask is, well, if you lose 50%, how much do you have to make just to get back to even? And oftentimes hands shoot up and they just say, if I lose 50% and I make 50% back, we should be right back to even. But the challenge with that is, the deeper you dig this hole, the longer it's going to take you to climb out of it. And a 50% loss has to be followed by 100% gain just to get back to the starting line. And what's interesting to us is, as we kind of look through this as well, on the bottom of the screen, what happens is, as these losses get bigger, our return level needed just to get back to even also grows as well too. So again, you dig this hole deeper, your upside has to be just that much bigger. So we talked about 50% here, but if you start to lose 60, 70% of your portfolio, 60% loss has to be followed by you doubling your money twice and then another 100% gain. So it's a 2.5 times return needed, or 150% gain just to get back to even. The way BlackRock and I know Chris and the group over at Signet believe as well too, is what we really want to try to do is certainly participate on the upside as much as we possibly can, but not to the point where we are sacrificing ourselves on the downside. So for example, last year was a really good example in March where the market was down 40% in about 3 or 4 weeks. But if you only lost maybe half of the downside, call it 20%. So still, you're going to go down when the market goes down. But if you can limit those losses to the best of your ability, you don't need 67 or 100% returns to get back to even. You know, a 20% loss is only required to have a 25% gain just to get back to your starting place. And frankly, if in March you lost 20%, you probably would have made that up by about mid-April with how crazy the markets got last year. So, you know, long story short, in our opinion, to us, we certainly want to be mindful and capture upside in the market to accumulate wealth, but we have to do so in a disciplined manner while not sacrificing and overextending ourselves on the downside. That to us is the critical investment tendency and characteristic that we all need to be thinking thoughtfully through.
You know, the other thing too, Connor, just to add in here very quickly, is when you look at this and you average this out, and this speaks to clients who like indexing or follow indices quite a bit. If you looked at what the average rate of return would have been for this period here, just in the gray corner, for the client, they would have received a return of $1, right? If they put in $1 and it went down 50, then back up 100, they've basically got their dollar back. That's a zero rate of return, correct? What would the index's average rate of return be over these 2 years? Do you see what I'm saying? It's not flat. It actually would show positive. If an index is down 50 but up 100, what's the average rate of return there? And so what I try to remind clients is when you look at this in very short intervals of going down deep and having to go up big, even when these certain things snap back or give you a percent return, that's not actually, as the investor, what you experience. And so getting back to even if you've had 100 upside on a 50% downside, is just a return of your own money. What the index may say is the average rate of return will be greater than what the actual investor experiences. And I just want to bring that up to people because we talked that about a lot in the meeting. When indices present certain averages, that doesn't mean that's the experience your actual money will have with the return of that index.
Yeah, totally agree. Yeah, sometimes the numbers can certainly be misleading, but when we're thinking about what does that actually mean for our account, that's what we try to focus on as well too, because that's quite frankly what we think matters.
Yep. Thank you.
So on the other side of this fence, envy is certainly a really powerful emotion that I think we've all probably had over the years in a number of different ways. The other part of this puzzle is what happens when things like March and April or 2008 occur in markets and we will lose money. And this tendency to act, or what we call sideline sitting, those can be really powerful fears as well too, that can certainly derail an investment plan as well. The way we kind of start this portion is this idea that all of us as people have a really natural tendency to do things and take action. And the idea that, and the old adage, if it's not broke, don't fix it, is said a lot. Unfortunately, us as humans feel the opposite as well, is true as well too, which is if something is broke or it is not working currently, we need to make a change and fix it. And a good example of this is the New York Times did a study called Goalkeeper Science. It's obviously a soccer study as well too, but in a penalty kick situation, just the kicker and obviously the goalie, statistics would actually tell you the best course of action for that goalie to do is just stay right in the middle. The majority of the time, that's where that shot ends up, and that would hopefully lead to the other team not scoring. But 94% of the time in this study called Goalkeeper Science by the New York Times, a goalie will jump left or right and try to guess what their opponent's going to do. That to us is basically emotions saying, I have to make something happen. And in the investment world, we call this concept timing the market, which I'm sure people have heard. But if you look at an example here, timing the market is really, first of all, challenging to do, but it's also not very successful. Even from the smartest investors in the industry within BlackRock and outside of BlackRock, they'd probably all tell you it's almost impossible to time the market, but more importantly, time it twice. So avoid down days and still capture up days, very hard to do. So we try to produce this visual here, which shows you a $100,000 portfolio in the S&P 500, and it takes it back 20 years. So it's a long sample size. And if you were to put $100,000 in the S&P 500 in 2001, that account would have actually grown to about $425,000 over those 20 years, which is a pretty impressive number. And that's just the market. However, what happens if we start to miss the best days in the markets? So for example, there have been 7,305 trading days up until the start of 2021. And if we were to miss the 5 best days in the market, so just about a week of trading, you would have actually sacrificed just about, actually a little bit more than $150,000, and your account would have only grown to about, call it $270,000. That's just 1 week of the best days. If you would have missed, call it 3 weeks or 15 days, business days, of the best S&P 500 days, you would have just about broken even, only about a $47,000 gain. And then what's crazy to us is, let's say you missed a month or the 25 best trading days in markets. You would have actually not even broken even. You would have actually lost about, call it $8,000. So the challenging part is what we hear so often is, well, you're taking out the best days. The most challenging part, and last year was a really good example, is that typically when people sell is right after the worst days. And the studies would actually tell you these best days all occur within 2 to 3 business days right after the worst days. And that just goes to show that sometimes these bad days in markets and good days in markets clump themselves together. And it can be really hard to see an account go down 3 or 4% in a single day and still want to invest. But to us, the most important thing that we can think through doing is, it's not to say never change your portfolio or never make active decisions. It's to say that the best strategy is keeping things invested at some level so that you're not missing these massive upside days that typically come very soon after some of the large down days as well too. That to us is really important. And on top of that, this feeling that the largest asset class that people own today is not stocks or bonds, it's actually cash. There is so much money on the sideline being waited to invest when the time is right, and I use that in quotations. To us, waiting for that right time to invest can often leave you, I should say, in the rearview mirror. And Einstein says it better than I can, but compounded interest is the 8th wonder of the world. And it's just this idea that money in the market is working for you. And if you take a same hypothetical portfolio of $100,000, and let's just assume every year you earn 10% on it. If you were to have a 10-year timeline with those same return numbers every single year, your account would have more than doubled to about $260,000. But if you were to cut those years in half and say, same portfolio, same returns, but you only have 5 years versus 10, your portfolio would have only grown about $60,000, which is great, but you would have lost out on almost $100,000, which is what you started with on top of that. And the idea is pretty simple, which is from year 0 to 1, you earned a 10% return on $100,000, and you would have been sitting on $110,000 in your account. But then from year 1 to 2, even though your return figure stays the same, 10% a year, you're earning that off 110, not 100. And this idea that if we can compound our returns on top of each other year over year, that is where the magic happens. And that's where you start to see some pretty exponential growth in your portfolio, especially over longer periods of time. So that to us is super, super important. And one thing that we want to emphasize, which is there's probably folks on this call that are sitting on more cash after a really volatile year. We're not telling you that you have to invest everything, but the more that you can keep assets at work, the more successful you will likely be in the long term as well too. And again, just to wrap that up really quickly, because I know we're a little tight on time here, but another quote from Warren Buffett is, one of the best strategies that we can take when it comes to the way we deploy assets and invest is to be really fearful, or maybe the better word is cautious, when others get really greedy. So you think about periods like 2019, 10 years into a bull market, everybody thought it was easy. That's the time where we want to be critical and a little bit more cautious. But also, on the other hand, we want to be a little bit more greedy and aggressive when others start to get fearful or cautious. So what that means to us is that in periods of April and March of last year, when nobody wanted to invest and there were so many questions out there, that's where you really get good value, and you should be thinking about, how do we get more aggressive right now when people think that the world is ending, unfortunately. And again, I was told early in my career, and I told Chris this over the years as well too, and I always get a chuckle out of it, but it doesn't matter what business you go to, whether it's a clothing company, whether it's a sporting goods store, when things are on sale, people gravitate toward that on sale rack. Investment is the only business in the world where when the on sale rack goes up front, the on sale sign goes outside the store, nobody wants to touch anything. And that's the time where you can have the best returns in markets. And March and April of last year were a really good example of that. So again, as you can see, certainly
Connor,
it can be,
yes. Connor, just as a quick add on that comment you made, what I find even more amazing is that when the average things that are on sale are being sold, they're all depreciating assets. The only thing that can go on sale and then actually go up in value over a longer period of time are securities. Everything else that goes on sale typically just continues to go down in value, whether it's clothing and it goes through wear and tear, a car off of the lot, a home amenity that you'll price out in 5 years. All of these things can be reduced, and we will go ahead and purchase those, because if we liked it at 10, we'll love it at 5. And yet we fail, all of us, included even us and early in our careers, to understand that, wait a minute, when that happens in the market, these things actually can go back up to where they were and beyond. It's even more compelling to get it, and yet we just don't do it. It's amazing.
Yeah, totally agree. And again, we use the example so often of, Apple last year in March and April, and even beyond that with a couple of different factors, went down somewhere between 5, 10, 15%, depending on the time period you look at. It was the same company. We all still have iPads and iPhones, and it's still probably the most profitable company in the world, Apple and Amazon. If you could get it at a 10 or 15% discount, why wouldn't you? And again, I think to Chris's point, Apple did not depreciate last year when it went down 10 or 15%. It was just an opportunity to deploy more assets, in our opinion. So I think it's a good point. I'm glad you brought it up. Just to kind of wrap things up, maybe I'll spend just a couple of minutes, but to us, the best thing that we can do is try to have some form of a process around how do we make decisions, when do we make decisions, and how do we ultimately build that discipline so we can follow those rules when bad things were to happen. And the first thing that we always recommend, BlackRock is a money manager. We're not a financial advice firm. Your best resource is Chris and Jerome and the team over at Signet Wealth. They do a fantastic job, and a financial professional so often is looked at as somebody that helps you handle your money. And that's certainly part of their job, but I think Chris will probably emphasize as well too, one thing that they serve as is just kind of a liaison between how you make decisions around your money and trying not to overcloud those decisions with emotions. It's always great to have a third party in the room. I think Chris and the group over at Signet do a fantastic job, but the first resource that we think that you have is your financial advice team over at Signet Wealth. I think that's an important place to start. And our 2 cents is, one thing that you should all be actively thinking through is, how are we going to prepare for the worst before it happens? And to us, we all kind of know, especially over the last 18 months, investments can be a total roller coaster. We go through all these different emotions. And, just as an example, you think about last year in January or maybe even December of 2019, we were probably all feeling pretty positive as we've seen how our accounts done over the last 10 years or 5 years, or even just in 2019. We probably got super confident to the point where there were a lot of investors out there that were frankly overconfident. Those are the times that we think discussing what our investment strategy is as the market's actually rising allow us to combat those emotions ultimately when it falls, so that when you're surprised in February hearing about this virus in China, and you start to get nervous in early March when you hear about the first couple of cases in the US, and then when everybody in the country is in full panic and frenzy mode in mid-March, we actually know what we're going to do without letting those emotions in real time start to overcompensate themselves, to say the least. And there's so many investors that we've talked to over the last 12 months that have gone through this roller coaster, and they end up somewhere at the bottom where they might have sold a large portion of their assets in March and April, missed all of this upside, and they kind of feel defeated, and they've really shot themselves in the foot, for lack of a better term. So to us, it is super easy to be overcome with emotions when markets are doing well, but especially when markets are doing bad. We want to avoid those roller coasters of emotion and try to find some sort of level in between it. So again, if we can discuss that investment strategy plan when things are going well, so we know exactly what we're going to do when things go wrong, that to us is a first step in the right direction on how to ride the ups and downs in markets as well too. So again, just to kind of wrap things up here, and I'll turn it back to Chris, and happy to stick around for questions, and we can certainly talk about markets if you'd like to. But to us, at the end of the day, investor behavior is the most critical piece of the investment puzzle. Chris and his team can pick the greatest stocks and the greatest bonds and put together the perfect portfolio. But if we are not disciplined enough to stay invested in it, it unfortunately won't work over longer periods of time. Number two here, the common investor biases that we see are a challenge for everyone, myself included, is two things. One, the feelings of envy, so that regret, S&P envy, or comparing our portfolio against the market, and that try to get rich quick lottery ticket effect. Those envious feelings are really challenging, and so are the feelings of loss and this idea of timing the market or not allowing your assets to compound themselves on top of each other. Those are the two big things that we see over and over again that really start to handcuff investors during difficult or even good times. And the last thing, we kind of just chatted through it, but a financial professional, it's their job to help you build discipline in your plan, but also ensure you that the decisions that you're thinking about making within your portfolio, within your broader financial plan, are the smart ones, but they're also rational thoughts as well too. So in our opinion, you certainly want to be critical, but be critical when things are going well, so that you can ultimately be opportunistic when things start to go a little bit south in a shorter period of time. So if we could try to instill some of those disciplined investor type of characteristics, that's what we're here to do. And BlackRock is a firm that is neurotic about understanding risk. And that to us are some of the foundational fundamentals that can be really successful over longer periods of time. So from that standpoint, I'll turn it back to Chris. I'm happy to stick around for longer and answer questions, but Chris, back to you.
Thank you very much, Connor, and thank you and BlackRock today for taking time out to speak with us. If there's one thing I can say, and I try to remind everyone I speak to about this, clients or new people I meet with, is that history really doesn't repeat itself, but it rhymes an awful lot with the past. If you look back at the last 150 years of the United States, you'll see we've gone through pandemics, world wars, waiting in line for gasoline, impeachments, great crashes, real estate boom and bust, stock market boom and bust. It's key to remind ourselves that we've actually gone through this stuff before in one way, shape, or form. And although it may feel very real or visceral at this point in time, we've actually seen something like it. And we at Signet rely on groups like BlackRock to say, hey, in 1957, for example, we saw this going on with rates, this going on with inflation. What was really happening back then? Help us unlock that and look at it so that when we work with our clients going forward, we actually have a place of strength and reference to point to so that we can move forward and get through it. It was a great advantage for us going through last year, and we were very proud of how we did, and even into this year. So in saying that, I don't see any questions at this point in time, so I think we'll be ready to wrap things up. Connor, again, to you and the team at BlackRock, thank you. To everyone who participated today, thank you. From myself, Jerome, Rich, and Mike, we want to thank everyone for sticking with us and continuing this journey. We look forward to talking with you soon. Thank you. Bye, Connor.